Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Thursday, March 19th, 2026. This one started with an oil spike and ended with the market just barely catching itself. Tone all day was cautious, risk off around the edges. Early on, higher crude sparked inflation anxiety, and that hit long-duration growth right where it hurts. Later, as oil backed off the highs, stocks stopped sliding. But that close? It felt like damage control, not a real buyers are back kind of day. On the S&P 500 heat map, it was mixed and choppy, but with a clear red tilt. The biggest visual weight was the problem. Mega-cap tech was broadly soft, so the usual shock absorbers just weren't there. Energy stood out as the clean green pocket, and the ugliest reds? They were concentrated, those bright blotches that scream targeted liquidation, not broad panic. Building on that heat map red, the flow was pretty straightforward. Capital hid in cash flow names and commodity sensitivity. Energy caught the bid, while traders trimmed high-duration growth across mega-cap tech, high-beta consumer, and media. The key nuance? This wasn't a clean defensives rip. Staples weren't leading. It looked more like de-risking and factor rotation off oil and inflation anxiety. And in semis, this wasn't just one trade, there was real dispersion, with a couple names holding up even as others got hit. Underneath all of this, crude was the macro trigger. Oil jumped. The market immediately priced it as inflation risk, and the sell buttons showed up in the most duration-sensitive places. Then oil backed off, and the tape stopped cascading. But it didn't turn into a celebration, one weird tell. Small caps finished up while the big indexes stayed down, more like a positioning adjustment away from crowded mega-cap leadership than a broad risk on stampede. On chatter specifically, there just wasn't any listed market chatter in today's inputs. The dominant narrative traders were trading off was simple: the oil to inflation to rates chain. If you heard extra desk talk on top of that, treat it as unconfirmed. Today's tape already had a clean macro driver. It didn't need a rumor to explain it. If you're watching the oil ticker, you're watching the wrong fire. The real disaster is at Ras Laffan. This facility is the heart of global LNG, and it just took a direct hit. Why do 3 to 5 years matter? Because in energy, natural gas is the marginal molecule. It's what keeps the lights on when everything else fails. With nearly 20% of global supply potentially sidelined until 2029, we're not just in a price spike. We're in a supply-side depression. This is an Armageddon scenario for energy-dependent regions, and it turns a lot of existing long-term contracts into scraps of paper under force majeure. Notice the massive wedge on your screen today. Brent is screaming toward 116 while WTI is struggling to hold 99. That $17 spread is the sound of the US economy divorcing the rest of the world. We're now an energy island. Because we're a net exporter with record shale flexibility, US manufacturing suddenly sits on a huge cost advantage. While German and Japanese factories face existential power bills, American industry is insulated. That spread is effectively a giant competitive tax on our rivals. And as an advisor, I'm telling you this is why capital's fleeing into the S&P 500 today. The Fed just locked in the stagflation late narrative by revising the PCE inflation forecast up to 2.7%. Jerome Powell's basically signaling that high energy is the new floor. But the hidden story is the AI trade. We've obsessed over the cost of chips. But what about the cost of power? AI data centers are voracious energy users. If natural gas stays elevated, those supposedly infinite margins at Google and Meta start looking very human. It's a double tax. It hits the consumer at the grocery store through fertilizer prices, and it hits the tech giants at the power plant. The CapEx flywheel just ran into a wall of physical reality. So how do we play this? For the rest of 2026, the theme is Energy Alpha. We're looking for companies with deep domestic energy moats, U.S. midstream LNG exporters like Cheniere, and domestic manufacturers that can exploit that $17 spread. At Cat Eye US Markets, we're watching the reshoring plays, names bringing production back to the energy island. The world has shifted. We're not just chasing growth anymore, we're hunting security of supply. In a 5-year repair cycle, the nation that owns the molecule owns the market. NVDA was one of the cleanest tells on the day. Down just about 1%, it traded like the market's AI beta under pressure when macro anxiety rises and traders trim duration. Context mattered. Semis weren't one big block trade. There was selective strength elsewhere, but NVIDIA finishing red kept the growth rebound from feeling real. Tesla was the big, bright red move in consumer discretionary, down just over 3%. The read is straightforward. On a macro risk-off day, Tesla often becomes the momentum pressure valve. When traders cut exposure fast, it tends to show up here early and loud. Micron dropped nearly 4%, and it traded like a classic good news, bad stock setup. Even with a headline beat, the market focused on what was already priced in and on the forward path. On a day already sensitive to multiple compression, Micron became a focal point for profit-taking. AMD was the standout on the other side of that semiconductor split, up almost 3% while broader megacap tech stayed heavy. The significance isn't just the move, it's what it said about the tape. Traders weren't indiscriminately dumping tech. They were selective, still bidding certain AI-linked exposure, even as they trimmed the crowded index leaders. Exxon was only modestly higher, up a touch, but it mattered because energy was the clearest green pocket on the board. The read ties directly back to the crude narrative. When inflation risk picks up, the market leans into commodity-linked cash flow resilience. Microsoft finished down just under 1%. In this tape, that matters, because megacap softness removed the usual index support. The analysis flags Microsoft as a key AI capex and megacap leadership bellwether. When it's red on a choppy day, it's a lot harder for the market to stabilize with conviction. Looking ahead to the next U.S. session, Friday, March 20th, 2026, the near-term question is simple. Does oil stay the macro trigger, and does index leadership come back? The next real data cluster is next week. Tuesday, March 24th brings Flash Manufacturing PMI at 9:45 a.m. Eastern, Flash Services PMI, and the Richmond Manufacturing Index at 10 a.m. Eastern. Thursday, March 26th is unemployment claims at 8:30 a.m. Eastern. And Friday, March 27th is the revised University of Michigan Consumer Sentiment at 10 a.m. Eastern. No predictions here, just the setup. If oil and rates calm down, the market may stop punishing duration. If they don't, the same pressure points can stay in play. Bottom line, today didn't resolve the inflation versus growth tension. It just eased the immediate pressure once oil stopped screaming higher. Energy held up. Growth stayed heavy, and dispersion was the real message, rotation and repricing, not a real break. Heading into the next session, the checklist doesn't change. Watch oil, watch rates, and watch whether the market gets its leadership back. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.